Hi everyone, it's me, your Manu Isu, and welcome to my YouTube channel Manu Isu ACCA classes. In today's video, we are going to deal with the section B part of consolidated statement questions of F7. If you are watching my video for the first time, please like and subscribe to my channel and share it among your friends so they could also have the benefit. And please don't forget to hit the bell icon for the more updates. Okay, so without wasting our time, let's move to the question. In previous video, I think we have done with the section B few questions. So this is, I think, last question for the consolidated one. Okay, so let's first read out what the question requirement is. Okay, so question number 291. What is the total consideration paid by Plateau company for Savannah company? Okay, so question is basically asking for the TPC, that is the total purchase consideration. So let's read out the first question. Okay, so on 1st October 2006, Plateau company acquired the following non-current investment. Okay. 3 million equity shares in Savannah company by exchange of 1 share in Plateau for every 2 shares in Savannah company plus 1.25 per acquired Savannah company shares in cash. And the market price of the East Plateau company shares at the date of acquisition was 6, and the market price of the Savannah company shares at the date of acquisition was 3.25. Okay, so from reading the first paragraph, we got to know the Plateau company is parent, right? And Savannah company is subsidiary, right? Okay, so what's the date of acquisition? It has been acquired on 1st October 2006, right? And our year end is 30 September 2006. Okay, so time of acquisition is October, November, December. Sorry, this is the X7. What I wrote. Okay, 7. So it's a 1 year. Okay, so 1 year. So now, parent percentage of acquisition. So parent percentage of acquisition, it is not given in the question. We need to find out. So we have given the number of shares acquired by the parent, that is the 3 million. So we will take a 30 as a common, so 3,000. Okay, and what is the total number of shares in the subsidiary, which is also given in the drafted financial portion. We can have a look. There is the equity shares of $1 is 4,000, and when we will multiply this by 100, we will get the parent percentage of the shareholding in subsidiary, which is 75. So basically NCI will be 25%. Okay. Okay. So now the first requirement of the question is asking for TPC, that is the total purchase consideration. So here the parent has acquired subsidiary by the exchange of shares in the Plateau. So basically there is a shares consideration, as I told in my previous video as well. So when we used to study the FA, there are only 2 kind of consideration, that is the share and the cash consideration, or the question sometimes might give the mixture of the both share as well as cash. But for the F7, there are 2 additional considerations we have to study. The one is the contingent consideration and other is deferred consideration. Deferred consideration means in future at a certain date you have to pay a certain amount which is given in the question. You just need to convert those future value into the present value by applying a discounting factor, which is also given in the question sometime, or sometimes cost of capital percentage is given. So by using that, we have to find out the present value. Okay, and contingent consideration is like it's like a probability. There are certain conditions attached to the payment. If that condition has been met in the future or will meet in the future, in that case you have to pay those amount, otherwise not. Okay, so here the share constitution have been done. So number of share acquired by the parent is 3,000, right? And there have been a share exchange. So we will multiply the how much share issued by the parent. In this case, for this scenario, every two shares in 3 million equity shares in Savna company by exchange of one share in the Plateau. It means parent has given one share and acquired the two shares of the subsidiary. Always remember, first multiply by parent, then divide it with by a subsidiary. So I have multiplied by 1 for the share issued by the parent, which is 1 given the question, and for every 2 shares acquired in subsidiary, so divided by 2. I will close the bracket. So now we will multiply with a market price of parent. So parent market price is 6, which is already given in the question. In case if question have told that the parent have acquired 75% of the subsidiary, in that case we need to find out on how much number of shares acquired by parent in the subsidiary. But in the question, to make it easy, the question has already told number of shares acquired by parent in the subsidiary. Okay, so this is the amount 9,000. So we have taken 30 as common. So I will just keep heading 30 as common. Okay, so now anything else given apart from this? Okay, yeah. Plus 1.25 per acquired Savna company shares in the cash. So there is cash consideration as well. So consideration. How much the shares have been acquired by parent in subsidiary? It's given the question, that is 3,000, and how much cash paid per share by parent is 1.25. So you might guys make a mistake here. You will not take the 3,000. Instead, you will take 3,000 into 1 divided by 2 for the share exchange, which has been done by parent and subsidiary between them. So don't do that. For the cash consideration, simply take the number of shares acquired by parent in the subsidiary, okay, and multiply with the per share cash paid by the parent, which is given the question is 1.25, right? So our total purchase consideration is, and what is the rest question is telling? Next part of the question, the market price of the each separate company share at the date of acquisition was 6, which we have already used this information for the calculation of shares consideration, and market price of the each Savna company share at date of acquisition was 3.25. So we won't take the subsidiary market price, we will take the parent market price for the calculation of share consideration, right? So total purchase consideration is 12750. Okay, for the question number 291, which is option C. Okay, so let's read out what is the next question requirement is. How should the customer contract in note 1 be accounted for? Okay, so note 1. Okay, so at the date of acquisition, Savna company has a 5 years remaining of an agreement to supply goods to one of its major customers. Agreement has been consistently renewed when it expires, and as the Plateau company estimated value of this customer based contract has a fair value of 1 million and infinity life and has not suffered any impairment. Okay, so the first option is should not be recognized as item is internally generated. Group shares of 75% should be recognized and not amortized. Okay, so I will explain this. So basically, this contract, which is the 5 years remaining of an agreement to supply with one of its major customers, agreement has been consistently renewed when it expires, and Director of Plateau Company estimates that the value of this customer-based contract has a fair value of 1 billion and has a indefinite life and has not suffered any impairment. As a contract estimated, contract having the indefinite life, so we want amortizes, and we will record the fair in our fair value adjustment of amount 1 million. So basically, option C will be the correct answer. We will recognize 1 million, but we want amortizes as it is intangible asset. So we want amortizes because it is having a indefinite life. That's why the option C is our correct answer. Basically, option A is telling this should not be recognized as an item. It is internally generated. Obviously, it is internally generated, but subsidiary will not recognize it in individual statement, but for the consolidated, we can recognize it. So option A is wrong. Group share of 75% should be recognized and not amortized. You haven't seen something like this. So when we used to prepare the consolidated statement of financial position, we want just to apportion the parent percentage for each and every item of the financial portion. We simply take the full value, and if there is amortization or depreciation, we need to charge on the full value or according to the mid-year acquisition or the depending on the full year acquisition, right? So we haven't seen something like this, we have taken the parent percentage of the each and every item of the financial portion. That's why this option is wrong. Okay. So, and the C is our answer. Should be recognized at 1 million and amortized over 5 years. So we want amortized is as I told the reason. So option D is also our incorrect answer. Okay. So next question: what amount should be shown as non-controlling interest in the consolidated statement of financial portion at 30 September 2007? So non-controlling interest amount is asking. So this is our working for which we while preparing the consolidated statement of financial portion, we used to do a 5 working. The first is for the group structure, second is for the net asset of subsidiary at fair value at acquisition as well as for the reporting date, and third is the goodwill, and fourth one is for the non-controlling interest which the question is asking, and the last the working 5 is for the group retained fund. So question is asking the working 5. So what kind of information is required for the calculation of non-controlling interest? The first we need the fair value of NCI at acquisition, right? Then post acquisition reserve, and we will multiply it by a NCI percentage. If there is any goodwill impairment, we will also deduct the NCI percentage of goodwill impairment from the working for. So let's read out the question. First, we need to find out post acquisition reserve, which we calculate from the working 2. Okay. So net asset of subsidiary at fair value at acquisition at reporting date, and difference of these two will get post acquisition reserve. I have written in the shortcut. So first we will take share capital, which will be same on the both sides, 4,000 and 4,000. We have taken the 30 as a common. So 1, 2, 3. So 1, 2, 3. Okay. So as I told, post share capital won't get any difference while calculating the post acquisition reserve because it is same on the both at acquisition as well as on the reporting date. So next we have a retained earnings. So retained earning and acquisition and for the reporting date. Acquisition have been taken place on 1st October 20x6. Okay. So retained earning given the question 6,000, and for the reporting date 6,000 plus 2,900. So this is the retained earning. Let's read out the additional information. If there is anything that we need to read deduct or adjust from the net asset of subsidiary at fair value. So first one is the at the date of acquisition, Savannah company had a 5 years remaining of an agreement supply goods to one of its major customers. An agreement has been consistently renewed when expires, and director of operating company estimated value of its customer base contract has a fair value of 1 and indefinite life and has not suffered any impairment. Okay. Just wait, okay? I will be back. So, customer base value is 1,000 million. Okay. Then not suffer an impairment, that is B, which is intangible assets. During the year ended 30 September 2007, Savannah company sold goods to Plateau. It means subsidiary has sold goods to Plateau, who is the parent, right? For 2.7 million, and Savannah company had a markup this good by 50% on the cost, so markup has been given. So I have told in my previous video and while doing question of F3 as well the difference between the margin and markup. So go through it. So one third Plateau company had 1/3 of the goods still remaining in the inventory at 30 September 2007. There were no intra-group payables receivable at 30 September 2007. Okay, so basically it is the intra-group transaction where the subsidiary has sold goods to parent. I have told in my previous video as well, if subsidiary sold goods to parent, in that case we will calculate the POP and deduct it from the working to which is the net asset of subsidiary at fair value. From the reporting date, we only deduct this amount, so less POP. But if in case parent is selling goods to subsidiary, in that case we will deduct POP from the working price, which is the group retained earning calculation. So POP minus what is the amount? 2,700 into how much good has been remaining? 1/3, right? So 1 divided by 3, and we will charge a markup which is the 50 divided by 150. So if markup is given, our selling price will be 100 plus the markup percentage here. In this case, it's 50 is the markup, so our selling price will be 150%. That's why I have divided with the 150. So 300 POP. And last one, it is a group policy to value non-controlling interest at acquisition at full or fair value. For this purpose, share price of Savannah company at acquisition there should be used. Okay. So for here, we are calculating the working force. So I will keep the heading working force. This is for the NCI. So fair value of NCI at acquisition. So fair value of NCI we calculate by the number of shares or percentage of NCI into total number of shares of subsidiary into the market value of subsidiary per share. So we have already calculated NCI percentage above 25%. In total number of share of subsidiaries 4,000, and market price of subsidiary we also given the question is 3.25. Okay, so then we will here PAR, post acquisition reserve, and I don't think we have given the goodwill impairment in the question. There is no goodwill impairment, so let it be. So let's do total first. Total. So post acquisition reserve is 2600. We will simply take this 2600 and multiply with the NCI percentage which we calculated above. So 650. So NCI amount equal to at reporting date this plus this. So 3900 is our answer. So let's look look on the option. Look at the option. There is first 3900. A is our answer, right? Okay. So next question, what amount will be shown in the consolidated statement of financial position as at 30 September 2007 in respect of the investment in the Excel Co. Excel Co. Yeah, we have information regarding the Excel Co. On 1st October 2006, Plateau company acquired the following non-current investment, and one is the subsidiary which we have done, and the second one is the 30% of the equity share of Excel company at cost of 7.50 per share. Okay, so initial investment 30% of total number of share of Excel company. It's given below, which is 4,000, and per share is 7.50. So initial investment is 9,000. So we do have given the profit for the year. So we will simply add PAT. Excel is the associate, right? And we will do equity accounting for the associate. Okay, so PAT means profit after tax. We will simply take parent percentage of the profit and multiply with the profit for the year of associate, which is given below, that is 5,000. You can have a look here. So we will add this amount. So 10,500 we will show for the investment in the Excel while preparing the consolidated statement of financial position. Okay. So next question is, Plateau company is negotiating contract to supply goods to Excel company in the coming year in the 30 September 2008 at 20% profit. How will the realized profit on the sales of these goods be adjusted in the consolidated financial statement for the year in the 30 September 2008? Select your own answer from the drag and drop option provided. Okay. So if a parent sold to associate or associate sold to parent, while we calculate the carrying amount of investment in associate, we will deduct the parent percentage of POP amount. And if the parent is selling, if especially parent is selling goods to the associates, in that case the POP parent percentage of POP will be deducted from the working 5. If parent sold to associates, then in that case only. Okay. So what is the question told? Plateau company negotiating contract to supply goods to Excel company in the coming years, and year in 30 September 2008 at 20% profit. So simply the journal entry is asking the question. The parent company will supply goods to Excel company. Excel company is the associate. It means parents sold goods to associate, right? So as I told, if parents sold goods to associate, in that case we will calculate the parent percentage of POP and deduct it from the investment in the associate, and as well as the group return. When we calculate group return earning, that is a working 5. from there also we deduct. And even though if associate is selling to parent, in that case we will only deduct it from the investment in the associate. So investment in the associate is shown while we prepare the consolidated financial portion. We will show the investment in the associate in the non-current assets, right? So now we have to deduct the non-current assets. So for that we will credit what? Investment in associate. Okay, and the profit which have been charged with parent will also be deducted from the share of profit of associate. Okay, so I hope you guys understand how I did this journal entry. Okay, so in this video we will do this much. For and next video we will doing the long questions. Okay, so thank you guys for watching my video. If you like my video, please subscribe to my channel and share it among your friends, and don't forget to hit the bell icon. Okay, so thank you so much. Have a good day.